Hi there. Capital gains tax, or CGT for short, has been a hot topic of discussion in Australia for quite some time now, and understandably so, as it can be quite daunting. In this video, we are going to debunk some of the most common myths about CGT, which could potentially help you save some money. So, sit back and enjoy the video. Let's begin with the definition of CGT. CGT is a type of tax that you pay when you sell an asset that has increased in value over time. This tax is applicable to various kinds of investments, such as stocks, properties, and land. To calculate the capital gains, you take the proceeds received from selling the asset and subtract the amount you paid for it, which is known as the cost base. If the proceeds are greater than the cost base, you've made a capital gain. Let's say Tony purchased shares in a company at a cost of $10,000 and decided to sell them for $15,000 after holding them for over a year. As a result, Tony realized a capital gain of $5,000, which may be subject to CGT. CGT, despite its name, is not a standalone tax. Instead, the net capital gain is included in the taxpayer's assessable income, along with income from other sources, and subject to the applicable tax rate for that taxpayer. To calculate the net capital gain, you need to subtract any capital losses, CGT discount, and CGT concessions from the capital gains. The rate of CGT that you will pay depends on several factors, such as your business structure, your income level, the type of asset sold, and the length of time you held the asset. Generally, if you hold an asset for a longer time, your CGT rate will be lower. If you're a company, you won't be entitled to any CGT discount, and you'll pay a 30% tax rate on any net capital gains, or 25% if your company is a base rate entity. On the other hand, if you're an individual, you'll pay the same rate as your personal marginal tax rate. Pre-CGT assets. CGT was introduced in Australia on the 20th of September 1985. Assets acquired prior to this date are commonly known as pre-CGT assets. Generally, pre-CGT assets are exempt from CGT. The acquisition date of the asset is therefore important in determining whether CGT is applicable. In some special cases, a pre-CGT asset can become a post-CGT asset, which would then be subject to the CGT provisions. Main residence exemption. When you sell a property, you may have to pay tax on the gain. However, if you sell your main residence, you might be eligible for a CGT exemption. To qualify, the property must be your main residence, and if you sell the adjacent land along with the property, the total area of the land and property should not exceed 2 hectares. Only a partial main residence exemption may be available if you only lived in a dwelling for part of the time that you owned it, and you didn't inherit it from a deceased estate. Or, if you rented the property out to earn income and claimed tax deductions on the mortgage interest. However, under the temporary absence rule, you can rent out your home for a maximum of 6 years and still consider it your main residence. Personal use assets. Assets that are used for personal purposes, rather than income generation, are typically exempt from CGT. However, if a personal asset has a cost base exceeding $10,000 and is sold at a profit, CGT may apply. Examples of personal use assets include furniture, sporting equipment, boats, cameras, white goods, and clothing. Suppose Katie purchased a motorboat on the 31st of January 2020 for $9,500. On the 1st of February 2023, she decided to sell it for $11,000. By subtracting the original purchase price from the sale price, we can calculate that Katie made a capital gain of $1,500. However, Since the motorboat is considered a personal asset, and its cost was below the $10,000 threshold, the capital gain can be disregarded. It is important to note that, regardless of the asset's cost base, any capital loss arising from a personal asset is disregarded for CGT purposes. Such losses are not available to offset capital gains on any type of CGT asset. To sum up, we have covered some important aspects of CGT in this video, including its definition, calculation, and common exemptions such as pre-CGT assets, main residence, and personal use assets. Please note that the content presented in this video is general and should not be considered as tax advice. Individual circumstances may vary, so it's recommended to seek professional advice from an accountant if you have any questions regarding CGT. If you found this video helpful, we would appreciate it if you subscribed to our YouTube channel or shared it with others.